Summary of The Warren Buffett Way. Investment Strategies of the World's Greatest Investor, by Robert G. Hagstrom, written and narrated by Janky Mind. Introduction. The Warren Buffett Way unravels the extraordinary journey of one of the world's most exceptional investors. Tracing his financial ascent from a modest $120 investment to a staggering net worth of $120 billion, this narrative delves into the captivating history and ingenious strategies of a man who consistently achieved the seemingly impossible, outsmarting the market. While Warren Buffett is often viewed as a statistical anomaly, the secret to his success may surprise you. It's not rooted in extraordinary intelligence or a privileged starting point. It doesn't rely on a mystical insight into the market. Simply put, it boils down to adhering to sound business principles and dedicating the necessary time, both of which are skills that can be acquired. Within the confines of this audiobook, we'll explore Buffett's formative years and the early lessons that paved the way for his investment triumphs. We'll delve into the pivotal figures and decisions that shaped his journey. Subsequently, we'll illuminate his fundamental business principles, unravel the psychology of finance, and underscore the significance of rational thinking. Chapter 1: A Promising Start. At the tender age of 11, Warren Buffett embarked on his investment journey with a modest $120 earned through entrepreneurial ventures like selling soda and peanuts. Analyzing price charts, he made his inaugural purchase, only to witness an immediate dip in stock value. Fearing further losses, Buffett hastily sold, pocketing a meager $5 profit. This experience imparted two invaluable lessons: never fixate on the purchase price, and never settle for anything less than a substantial profit. Buffett's subsequent ventures, however, reflected a Midas touch. After graduating college, he diligently secured a position at Graham-Newman Corporation, where he honed his trading acumen. At the age of 25, he founded his first limited liability partnership with a $100 investment and a straightforward goal: outperform the Dow Jones by 10% annually. Remarkably, he exceeded this target by 22%, growing his investment to $25 million over a 12-year span. In 1965, 4 years before concluding the partnership, Buffett acquired Berkshire Hathaway, initially a cotton manufacturer established in 1889. Sensing the decline of the textile sector, he made a pivotal decision in 1967 to acquire outstanding stock in two robust firms, National Indemnity Company and National Fire and Marine Insurance Company. This strategic shift propelled Berkshire Hathaway from $2.9 million in securities to $5.4 million in just 2 years, setting the stage for its evolution into an investment behemoth. From an initial $100 investment, Warren Buffett's net worth has burgeoned to over $100 billion, challenging the conventional wisdom of the efficient market hypothesis. While some attribute his success to a genetic lottery, the subsequent chapters of this audiobook aim to unveil Buffett's market-beating prowess as a product of skill rather than mere chance. Chapter 2: A Good Education. In 1921, Mary C., the founder of C's Candies in Los Angeles, established a legacy that transcended generations, navigating challenges like the Great Depression and World War II. In 1971, Berkshire Hathaway acquired this multi-million-dollar enterprise for $25 million, a testament to the enduring power of quality. To grasp the significance of this acquisition, it's crucial to delve into the influences shaping Warren Buffett's formative years. Benjamin Graham, author of seminal works like Security Analysis and The Intelligent Investor, laid the foundation during Buffett's tenure at his company. Graham's cardinal rule, "Don't lose," instilled in Buffett a meticulous approach to investing, emphasizing companies selling below 2/3 of their value and possessing a low price-to-earnings ratio. Another influential figure in Buffett's education was Philip Fisher, who championed a philosophy centered on quality over bargains. Fisher's ideas permeated Buffett's investment strategy through his close associate, Charlie Munger. Munger, initially a lawyer turned investor, merged his blue-chip stamps with Berkshire Hathaway, becoming vice chairman. The acquisition of See's Candies, based on Fisher's principles, marked a departure from Buffett's Graham-inspired methods. Reluctant at first, Buffett yielded to Munger's persuasion. A decade later, faced with a $125 million offer for See's Candies, Buffett declined, underscoring the enduring value of quality investments. This decision, rooted in Fisher's philosophy, reaffirms Berkshire Hathaway's continued ownership of See's Candies to this day. Chapter 3: The Buffett Buying Guide. Warren Buffett's discerning approach to business investments is encapsulated in 12 tenets developed over decades. First and foremost, he advocates investing within one's knowledge domain, emphasizing simplicity, consistency in operating history, and a favorable long-term outlook for chosen businesses. The evaluation of management, a nuanced process, involves the scuttlebutt method, gathering anecdotal information through conversations. Buffett seeks financially prudent leaders who are candid with shareholders and exhibit resilience in decision-making, even if it means admitting mistakes. Financial scrutiny relies on 5-year averages rather than yearly results. Key metrics include returns on equity, owner earnings, high profit margins, and increasing market value. 2 market considerations, value and price, conclude the analysis, ensuring alignment with intrinsic worth and long-term potential. Buffett's ultimate goal is to acquire well-managed companies with integrity and significant growth potential. These tenets, refined through decades of experience, guide his investment decisions. Chapter 4: Meet Mr. Market. In the realm of investing, envision a partnership with Mr. Market, an emotionally volatile companion offering to buy shares daily. Regardless of your business's stability, Mr. Market's mood swings lead to varying offers. While tempting, it's essential to resist succumbing to his influence and instead make decisions based on objective analysis. This analogy, crafted by Ben Graham, highlights the need for psychological readiness in investing. Behavioral finance, a field addressing psychological traps, reveals pitfalls like overconfidence, loss aversion, and the lemming effect, following the crowd. One complex trap is overreaction bias, mistaking unrelated events for trends. Mental accounting, another trap, involves assigning different values to the same money based on circumstances. The deceptive myopic loss aversion, identified by researchers Thaler and Benartzi, underscores the attractiveness of long-term investments when evaluated infrequently. Emotions often drive market movements, requiring investors to be psychologically prepared for fluctuations. Patience, a key attribute, plays a crucial role in navigating the emotional landscape of investing, as explored in the final section. Chapter 5: Patience and Rationality. A comprehensive study spanning 43 years scrutinized the 1-year, 3-year, and 5-year returns for S&P stocks. The findings revealed that, on average, only 1.8% of stocks doubled in 1 year, rising to 15.3% for the 3-year period and 29.9% for the 5-year horizon. The study aimed to address the possibility of substantial returns from long-term investments, affirming that such returns are indeed achievable. However, the majority of stock market activities are characterized by reactionary, short-term thinking, deviating markedly from Warren Buffett's distinctive approach. Buffett, emphasizing that his prowess stems from patience and rationality rather than intelligence, distinguishes between the two concepts. Rationality, a key component in his success, involves slow and deliberate System 2 thinking, as opposed to the fast, intuition-driven System 1 thinking prevalent in stock market activities. Daniel Kahneman's book, Thinking, fast and slow, delves into the dichotomy of System 1 and System 2 thinking. System 1 operates swiftly based on intuition, while System 2 requires reflection and good judgment. Buffett's adherence to System 2 thinking aligns with the requirement for self-control, often perceived as unpleasant due to the distant payoff. This emphasis on patience sets him apart. An experiment conducted by Yale University professor Shane Frederick highlighted people's discomfort with System 2 thinking. Many students, even from prestigious Ivy League schools, erred in math questions that demanded a moment of reflection. Frederick concluded that people are unaccustomed to using System 2 thinking, and the brain System 2 component inadequately monitors System 1 for errors. Failure to exercise patience and rational thinking creates a mindware gap, causing individuals to miss crucial information during investment research. Buffett's approach involves reading annual reports, analyzing competitors, running growth rate models, understanding capital allocation strategies, and gathering anecdotal information through conversations, a process known as scuttlebutt by Fisher. To achieve Warren Buffett's level of success, embracing the discomfort of System 2 thinking becomes essential. While it may initially be uncomfortable, the long-term rewards make it a crucial component of successful investing. Summary. Absolutely, Warren Buffett's journey is a testament to the extraordinary possibilities that arise from humble beginnings. From his initial investment at the tender age of 11 to the modest $100 investment that marked the inception of his limited partnership, Buffett's trajectory defied conventional norms. Today, boasting a net worth exceeding $100 billion, he stands as a living example of accomplishing the seemingly impossible. Buffett's success isn't just a result of financial acumen, it's a product of playing the game differently. Sound business sense, coupled with psychological resilience, patience, and rational thinking, forms the cornerstone of his approach. His belief that these qualities are replicable suggests that, irrespective of one's starting point, anyone can aspire to emulate his success. It's a powerful testament to the idea that the principles guiding Buffett's journey are accessible to those willing to embrace them. This audiobook summary was brought to you by Janky Mind. We hope you enjoyed it.